Excel accounting practice problem. Adjusting entry related to unearned revenue or customer deposit. Get ready because we're about to excel. Here we are in our Excel worksheet. In prior presentations, we put together the worksheet from a blank sheet, now continuing to enter transactions into it. If you have access to it, there's two tabs down below, an example tab and a practice tab. The practice tab starting out where we left off last time, and the example tab in essence being an answer key. Let's take a look at it now. We're focused on the unearned revenue. If you've seen unearned revenue in accounting classrooms, we're going to be doing an adjusting entry that looks a little bit different than it would traditionally be recorded because we're trying to mirror what is often done in accounting software. Let's see if we can explain this in a bit more detail before we move forward here. Now, note that the unearned revenue is often one of the more confusing adjusting entries because it's a type of account that you won't see all the time. It's going to be the type of account that's going to be there and in place for certain types of industries that are going to get paid before they do the work. In other words, usually you're going to do the work at the same point in time. Think cash register, for example, making the sale within the store, like selling a guitar within the store in our case, and you get paid at the same point in time. Or you do the work beforehand. You can think about like a law firm, bookkeeping firm, or something like that, where they bill out the time that they have worked for, and then they're going to get the money at a later point in time. Some people, however, get the money beforehand, and so certain types of industries will be more focused in on the unearned revenue, although those industries are more rare. Possibly they're increasing in nature, however, because the classic example is a magazine company or a newspaper where you get a year's worth of subscription up front and then you deliver the newspaper, therefore you get paid before you do the work. Computer applications are now often on a subscription model, so that's a growing area where you have the same kind of phenomenon, getting paid first before you've actually earned the revenue. So traditionally then, in a normal book problem, you would think you would want, when you earn the revenue or get the revenue, to increase unearned revenue here as you get the money if you're in a normal subscription model. And then periodically you go through and determine how much of that money you have actually earned, lowering the unearned revenue and then recording the revenue at this point in time. So normally in an adjusting entry for like a book problem, what you would be doing is saying, okay, how much of this unearned revenue, and remember, if all of my revenue was from subscriptions, then I would set up my accounting system to just basically have the unearned revenue increasing every time cash was received from a customer, and then try to determine on a periodic basis how much of that revenue had actually been earned, moving it from unearned revenue then to revenue at that point in time. Now that works great in theory, but there's kind of a problem with this unearned revenue account in that you're trying to track the revenue that you have earned from customers in a liability account, which isn't a natural thing to do, because normally when you're tracking payments from customers as well as what is owed, you do that in the accounts receivable account. In other words, if you're trying to design accounting software, you have a subledger for the customers supporting the accounts receivable account, and the customers are typically tied to the accounts receivable account. So therefore, when you get a prepayment, a deposit, it's a little bit more difficult to determine when the revenue has been earned or invoice the client at a later point in time when you're using this liability account, which isn't typically tied to the customers instead of the accounts receivable account. So what will often happen in practice, and there's different kind of workarounds that you will see, but accounting software, using accounting software, one method to deal with this and be able to track, how much has been owed and tying out the invoice to the prepayment is to create a negative accounts receivable instead of a positive liability account. We saw that, we talked about this when we did like the data entry portion of this. So now we've got these negative kind of receivables in place. The reason that's useful, if I go over to the subledger to the right-hand side, if I go all the way to the subledger, then what's going to happen is the total balance in accounts receivable is still a positive, but you have certain people, certain customers that have these negative balances in there, meaning that's a prepayment. That's us getting paid before we did the work instead of us recording it in a liability, which is more difficult to then track in this subledger too, we've recorded it in a negative receivable, which is often the case you might see in accounting software. And now at the end of the period, we want to determine if there's still some of these negative amounts that are outstanding and do an adjusting entry for them. So the adjusting entry here is not going to be to recognize the revenue at that point in time, but rather to increase the accounts receivable to what it should be without having these negative or prepayments in it, and the other side going to then the unearned revenue, the liability account. So that's going to be what we will do this time. And then when you actually in our scenario that we have here, we're going to say that we have a prepayment that took place for a guitar, and that's another area that you might have a prepayment. We talked about rental property where you might have a prepayment, meaning if you have a rental, then you might get a deposit first, which is kind of like unearned revenue, acts in a similar way. You owe the money back, so it should be basically a liability. And if you are going to be having inventory that's custom made in some way, and you have to order it or make some kind of custom formatting for it, then it's often the case that you're going to ask for a down payment up front, and then at a later point in time, you're going to then give the item, in our case, the custom guitar or the guitar that we had to order. So at the point in time that they want to reserve the guitar, they're going to give us a down payment of some kind. For example, here Smith Guitars gave us a down payment. We didn't record a positive liability at that time. We've recorded the negative receivable so that we can record it in the subledger here. And you can see this happened over here for Anderson Guitars. And then at a later point, when we deliver the guitar, that's when we would record the invoice. And the invoice is the point in time under this kind of system, under this method, where the actual revenue would be created. So we would then post the revenue properly when the invoice is created. And then you would have this unearned, and then these two would basically net out at that point in time. This also makes it easier to take the prepayment and tie it to the invoice. In other words, if I look at the subledger here, I can see, okay, yeah, these two things net out here, but I'd also, with an accounting software, like to tie this payment to this invoice, which again is a lot easier to do if the payment is in the same subledger as the invoice that is going to be made. So that's going to be the basic idea of it. So if we go over to the practice tab, we're going to record this out. The general idea is we've got these negative items in the accounts receivable. The accounts receivable is still positive, but we recorded some of these negative items that I'm going to have to search through in the subledger, and then I'm going to increase the accounts receivable to accommodate for that, to get it to where it should be, and then we're going to create a increase in the unearned revenue account. So to do that, let's do the journal entry first. I'll go to the journal entry down here. It's going to be at 228. We expect then unearned revenue to go up and accounts receivable to go up. So it's going to be a debit to the AR or accounts receivable, and there's going to be a credit to the unearned revenue. That's going to be our journal entry, straightforward journal entry, although again, it's a little bit different than you might see in accounting textbook due to that. And then we're going to go to the right-hand side, looking at the subledger, and analyze the subledger to see if we have any of these deposits that are in there, noting that once the actual invoice has been put in place, then I'm not at a problem anymore. In other words, at this point in time, when I got the prepayment and I recorded a negative receivable, it's not exactly correct because I should have a positive liability, not a negative receivable. But once the invoice is completed, then I'm back in a good position. Everything's back to where it should be because I have a positive receivable and I don't have this negative kind of receivable problem. If I have a situation where I got a deposit and then I had not yet created the invoice as of the cutoff date, the date we want to make the financial statements, that's when we have the problem. So I have a problem here with the Smith, and I have a problem with the customer one here. Actually, these two net out somehow over here. And then we've got the problem with the Eric Music, so that's going to be the 450. So we got the 450 from these two customers that we need to be dealing with. Now, the other thing we got to consider is that what I need to do then is reduce the receivable down to zero. When I reduce the receivable, if you're using something like QuickBooks software, they're going to force you to put something to the customer item. I don't really want to put something to the customer item here or here because I don't want to mess up the normal bookkeeping process. The normal bookkeeping process works fine this way. It's just for display purposes. I need to make it correct as of the end of the period. So what I'm going to do, instead of posting something to these items, I could either create another accounts receivable account that's an other current asset account that doesn't touch these items, or I could create another customer, which we did before, and make it our adjusting entry customer and just put our adjusting entries into this area so that we don't mess the actual customer detail up, especially in a situation where you got this prepayment, which is a little bit more confusing. So let's do that. I'm going to go all the way to the right and record this out, and the journal entry is going to be fairly straightforward. It's just going to be for that 450 for those two customers that had the deposit that had not yet been invoiced out for because we haven't received the guitar yet. We're going to be debiting the accounts receivable, so I'm going to go up top. Accounts receivable needs to go up, double clicking on it, go to the end of it, and plus, scrolling down, we're going to pick up that 450. So accounts receivable goes up to the 23,151, and then we're going to go down to the unearned revenue, and this equals, and we're going to then be picking up that 450, bringing it up to 450. So now for demonstration purposes or for presentation purposes, this is done more correctly. Instead of having a negative receivable inside of this receivable balance, we broke it out to a positive liability. So then if I enter this into a QuickBooks software, again, anytime I do something to accounts receivable, if you give this to, say, the accounting department, say, I need you to enter these adjusting entries, they're going to say, oh, no, you hit accounts receivable. I don't know what to do with that because it's going to mess up my subledgers. I don't want to enter that into my system. My system works fine. You know, I don't care if you had to do what you got to do to get the financial statements correct. But if I enter that into my system, it's going to mess up my subledgers. So what we want to do is, if we have to enter it in, we could make another account, or that's an other current asset instead of accounts receivable type account, or we can put it into this other customer so that we don't mess up the actual customer. So when we post it to the subledger, that's what we'll do. So let's post it out first. We're going to say accounts receivable. Let's post it to the GL first. I'm getting ahead of myself. I'm way back here, but then like myself is way up somewhere else because I'm ahead of myself. ADJ, we're in BB20. Let's record it in BB20 equals left to the wall, scrolling down, and 450. So now the total here is going to be at the 23,151, 23,151, matching what's on the trustee trial balance, and we're back in balance up top. Then we're going to go down and say that we got the unearned revenue is the next one. That's the last liability account in the trustee TB trial balance. So it's going to be the same in the trustee GL or the GL. I need another word other than trustee. There's something GL. So we're going to go over here to the GL. It's the last one, unearned revenue. This is going to be ADJ. We're in CH7. CH7. We're at CH7 equals left to the wall and scrolling down to the unearned revenue. You didn't earn that revenue. You didn't earn that revenue. You didn't earn it. So that brings it up to the 450. That should put us back in balance. Back in balance on the GL. Back in balance again. And then down here we're at the 450. So now we'll go to the subledger and do our subledger thing. And like I say, if you didn't have to hit the subledger, then that might actually be good, because this is one that we're going to do a reversal for. We will reverse it out. This is just something that we want to make correct for presentation purposes, but then reverse it out so it doesn't mess up the accounting department, which is doing it in a way that works for them. So instead of decreasing these two items, the 250 and the 200 here, I'm going to put it into my other customer over here, and I'm going to just tell the adjusting department, hey, look, this is my adjusting entry customer, and it should net out after the reversing area. So hopefully that doesn't mess you up too bad. And this is an EP19 equals left until we hit the wall. And then we're going to scroll down to the unearned revenue. We're picking up the 450, enter. So there we have it. That brings this down to 75. If I add up my customers in the subledge, we get then this, because I picked up the wrong number. Hold on a second. Something went horribly wrong. I picked up the credit, and I need the debit, don't I? I need the debit, don't I? Let's do it again. EP19 equals left to the wall until now we're going to pick up the correct number. This time, 450. That's what the check figures are for. That was a check figure demonstration demo test. So then I'm going to go back on over here and say that we've got, it looks like it matches out. The 23151 and is what adds up my customers, 23151. That should be what's on the trusty TB as well as the GL. Let's check it out. So there it is. So that looks good. So now, again, this is one of those ones that we want to reverse as of the first day of the following period, and we will do that next time. So this is where we stand at this point. Notice there's no impact on the income statement from this transaction, and if you were doing a method similar to a book problem, there would be an adjustment, because what you would do there, you'd be trying to determine how much of the unearned revenue had been earned. That wasn't our problem now. When we earn the unearned revenue under the method we're using, we'll know it because we'll actually issue an invoice. So that's not the problem. The problem is just simply the reporting between a negative receivable and a positive liability in this case. So this is where we stand at this point in time.